So, firm valuation here is what we're going to do in this week's portion, FCFF valuation. What are we doing over here? Well, this is rather an indirect method. Remember why do I say indirect? Remember, we are focused on the true value of the stock, equity, not the debt, right? Equity. So FCFE or DDM, that was direct valuation, directly hitting upon those value for equity holders. Instead, over here, we are first estimating the value of the company, the asset, okay, asset. And then we are going to subtract debt to get to their equity value. So it's like a three cushion kind of, like if it is like 당국 kind of pocket ball kind of things, right? It's going to, it's just indirect approach. So that's what I'm saying. Rather indirect method. The first thing that we are going to estimate is something called enterprise value, EV. Okay, enterprise value. What is that about? Enterprise, that's the value coming from your day-to-day business. Okay. Value of a part of your asset, which is excluding your cash. Your asset has two parts. Don't say current asset and fixed assets. No, I'm not talking about that. You can classify assets in many different ways. One way of classifying asset is cash and non-cash asset. Okay, cash, that small amount, right? And then non-cash, the majority amount, yes. That's what we call enterprise value, because that is coming from your, that is those assets, those non-cash assets is dedicated to your day-to-day business. Okay? And we are trying to estimate the market value of that enterprise. Okay? And cash, why do you single it out, by the way? Well, cash is just stuck on your bank account. Okay? Stuck on your bank account. Typically, what you do is put this money into treasury, US treasury or something like that. Cash is risk free. Beta, zero. Not one, man. Okay? So many of the people get confused. Cash beta has to be zero, not one. Come on. That's just separately sitting over there, sleeping like nothing to do with the day-to-day business, right? Sitting over there. Bank keeps it for you, right? That's that. The operating part is important. That is enterprise value, which is your free cash flow to firm, discounted at weighted average cost of capital. Okay? Why WACC? Because this FCFF is a cash flow available to both debt holders and equity holders, right? WACC. And then for that part, if we have multi-stage growth model, okay, cash flow projection, you will do it like this on the far right hand side. If, on the other hand, if you believe that the company has no growth potential, right, it will grow slowly, so that the growth rate of earnings or EBIT will be less than, less than your WACC, okay? Then you can use this one-stage growth model like this. We called it golden growth model. Remember that? Yes, that's it. What stage? How many different stages of growth do you need? Clearly, this is one stage, and the other is two or n different stages, right? 2, 3, or something like that. We are going to touch on this 3-stage growth model today, so wait for that one. Okay, it's going to be fun, by the way. Now, once you compute or estimate the enterprise value, what do? Add the cash, because this is your asset, okay? So that you will get the firm value. I say asset value over here. Okay, total asset. That should be asset. It should be equal to debt plus equity. That's accounting identity. That's this part. Debt plus equity. But we are talking about market value terms. Market value, market value, market value. And here the debt, okay? I told you about this in your Q&A session video, which is recorded in Korean language. By the way, in Q&A session, I'm just speaking in Korean language because I know 100% of you are Koreans, right? I found no foreigners in this class. So, and then plus, many of you had a hard time understanding my English. I'm sorry. Okay, my broken Konglish or Singlish or whatever English or Jenglish. So I'm speaking in Korean over there, right? But don't blame me in saying that in your teaching evaluation, oh, this guy was speaking non-English a little bit. No, 100% I speak in English for regular class sessions. So don't check that. Come on. Anyway, so debt, okay? Getting back to this debt. What is it? Not total liabilities. No way. Why is it, right? We are focusing on only the interest-bearing debt. We are interested in the financing side. Capital raising part. Financing part. Okay? Raising money. Okay? So, accounts payable, it's not about raising money. So it should not be here. Accounts payable is for inventory, working capital kind of things. Send them over there, forget about it, okay? Deferred tax liabilities. Well, that's about not raising your capital, but it's just accounting adjustments about whether you pay tax today or next year. Okay? You have some tax obligation over there, which has nothing to do with raising money to do your day-to-day business. Okay? Oh, a little bit of money left over. Can't we just do business with it? Yeah. Maybe you accountants, yeah. But no, okay? Don't include deferred tax liabilities, right? And then other small miscellaneous items in liabilities, forget about it. I told you, right? So short-term debt, long-term debt, interest-bearing, okay? Pretty much it. Sometimes corporate bond, if you have it. Plus notes payable. Notes payable, that is interest-bearing, okay? And it is a short-term financing. Notes payable, what is that? This is NP, which is different from accounts payable. Notes payable is about 기업 어음, okay? Short-term IOU, which is like you have to repay it within 30 days or 60 days kind of things. Short-term financing, quick money, okay? Then some people call it CP, corporate paper, okay? Commercial paper, sorry. Commercial paper, okay? That's it. And then financing lease, right? Financing lease. Now the accounting regulation changed so that you don't have to worry about operating lease. Leasing, for example, Starbucks, right? They don't directly own all those buildings. They are not 건물주, right? Why not be a 건물주? 건물주 is above like a 조물주 kind of things. No, for Starbucks, right? Being a 건물주 gives them involves too much risk. Okay, the real estate price risk. Okay, so they want to get away from that so that they lease it. Okay, so for that part, lease obligation, right? Lease obligation works exactly like a debt financing. If you happen to miss the lease payment, rent, okay, your company is essentially bankrupt, technically bankrupt, okay? It works exactly like a banker's. So that's why financing lease should be treated as debt, okay? So this kind of things will bother you when you do I-Corp project. Okay, looking at financial statement, you'll wonder, should we include this into debt or not? Every item, okay? But remember, is this capital raising part and financing lease, just like interest payment, okay? So that's pretty much it. Market value of equity, that's market cap, 시가총액 kind of things, right? So our final destination is this guy, market value of equity. So if you solve for this, this should be enterprise value, which is this guy, plus cash minus debt, right? So many people miss this part or that part, so they get some points off, okay? Don't forget. So that's that. WACC model, okay? Once you get the free cash flow to firm, what do? Discount it at weighted average cost of capital, right? WACC. This is the residual cash flow so after meeting all the obligations. So yeah, so it's self-evident. Just go ahead and read it. FCFF, free cash flow to firm. How do you compute or estimate this one? Okay. Again, we start from the same thing. After tax operating income or NOPAT. Okay. And then our ending destination, our final destination is FCFF. So on the way, what do? Minus all those investment amounts, as I said before. Okay. Or in a word, we say it reinvestment. Okay. Reinvestment. That's minus computation. The third formula, okay, represents it with multiplication sign over here, okay, which is reinvestment. I want to have some reinvestment rate to summarize all these things. Its relation to NOPAT amount, okay? So 1 minus reinvestment rate, if you multiply this guy, then that will be to the NOPAT, right? That will be the free cash flow to firm, okay? Yeah, so if you do the math, you will realize these two formulas are the same. These three are the same. Okay, we are just simply representing in different ways. Why do we do it? Because, why do I show you in 3 different ways? Because depending on the information that you got, you should be able to move around either this or that or that. I can ask you with reinvestment rate information with NOPAT amount. Alternatively, I could ask you with reinvestment dollar amount. Okay, that's this guy. Alternatively, I could ask you with detailed amount about capex, depreciation, and then working capital information. Okay, so depending on the situation, you should be able to move around, right? So that's why. Now, WACC model. Of course, getting back over here. Would we get identical amount of free cash flow to firm regardless of which way we do it? This way or that way or that way? In theory, yes, but in reality, no. Okay? Because my dog is barking, right? Okay, so in theory, it will be the same, but in practice, not really, because you will see later, reinvestment rate is summarizing a lot about it, whereas this one, detailed items may vary a lot. Okay, for example, I may impose some average reinvestment rate. Okay, average reinvestment rate that I estimated over the last maybe 5 years history. Okay, and then impose this guy onto the future. Okay, what if in the meantime this detailed amount fluctuates a bit? Okay, year by year, those FCFF may differ, right? So those things are not necessarily ending up with the same identical number in practice. In theory, it should end up with the same number. Okay, so that's